The S&P 500 is worshipped like the holy grail of investing, but I think it's one of the riskier bets long-term investors are making today. Why? Because what used to be a diversified portfolio of America's best businesses now behaves more like a tech-heavy ETF with a patriotic label. The reality is the S&P 500 may not be as safe as you think, and concentration risk could hurt your returns far more than you expect. And I'm not saying the S&P 500 is a bad investment, but I am saying it's no longer the no-brainer people assume it is, especially when better options exist. By the end of this video, you'll understand why I avoid the S&P 500 in my own portfolio and what I believe is the better long-term bet for most investors. And if the S&P 500 is so risky, why does everyone still recommend it? And we'll explore that near the end, and I'll show you how investor psychology, media repetition, and even index marketing might be influencing your decisions more than actual data. So first of all, why would anyone avoid the S&P 500? Well, most people think that the S&P 500 gives them a slice of 500 companies, and technically it does. But the reality is somewhat different because as of 2024, just 7 companies, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, made up over 28% of the entire index. That's 7 companies controlling over a quarter of what's supposed to be a diversified portfolio. It's like ordering a Nando's and 28% of your order is peri-peri chips. Now, nobody goes for Nando's for the chips, or if you do, then you are a bit weird. But if your chips are undercooked and cold, then you've got a problem. And this extreme weighting is due to the S&P being market cap weighted, meaning the biggest companies get the biggest slice of your money. Now, if tech is flying, then great, because everything's funny when you're making money. But if big tech stumbles like it did in 2022, you can suddenly be exposed to much more risk than you think. In fact, in 2022, the S&P 500 dropped nearly 20%, largely due to a tech sell-off. And what's scary is that this kind of concentrated exposure doesn't show up in most beginner-friendly investing apps. It just says S&P 500 and everyone assumes it's safe. And just to be clear, when I started managing my own money full-time back in 2016, I said to people either look at S&P 500 or world. And the S&P 500 has been a huge winner in that period. But as we've seen, it's anything but balanced. Plus, we've got political risk with Trump, as we've seen in the recent tariffs crash. And this brings us to the smarter alternative, in my opinion, a fund that truly spreads your money across the globe. Because whilst the S&P 500 focuses on 500 large US companies, the FTSE All-World Index spreads your money across more than 4,000 companies in over 50 countries. It's made up of about 90 to 95% of the investable global stock market, combining both developed and emerging markets. So instead of betting on one country with the US, you're actually investing in the world and betting on global capitalism. And whilst the S&P 500 is currently dominated by US tech, the FTSE All-World includes exposure to sectors and regions that often move differently, like Asian consumer goods, European finance, and Canadian commodities. And this geographic and sector diversification helps smooth out returns and reduce volatility. So you're not reliant on just one economy, one central bank, or one market cycle. And the easiest way to think of this is like building a football team. You don't want 11 Alan Shearers. You want a mix of quality defenders, midfielders, and someone who can actually score, unlike England strikers at big tournaments. And the data backs this up because over the last 10 years, the FTSE All-World has returned around 9.5% annually versus 11.8% for the S&P 500. But here's the kicker, that gap is almost entirely due to US tech exploding post-COVID. So if you remove the Magnificent Seven, the difference actually becomes negligible. So the FTSE All-World may not always outperform, but it does perform more consistently. And that matters if you're investing for the next 30 to 40 years. But beyond performance, there's an even more important issue, risk, because the S&P 500 isn't just concentrated in tech, it's concentrated in optimism. And here's what I mean by that, because most people who invest in the S&P 500 believe 2 things. First, that the US will always be the best performing market. And secondly, that big tech will always lead the way. But history does suggest otherwise, because in the 2000s, the US actually underperformed global markets, emerging markets, and Europe led the pack. The Nikkei 225 was the global leader in the 1980s until it crashed and took over 30 years to recover. And the reality is that no economy, not even the US, leads forever. And when you invest in the S&P 500, you're implicitly betting that US large cap tech stocks will continue to dominate for the next 20 to 40 years. And that is not diversification. What that is concentration dressed up as convenience. Now, if we compare that with the FTSE All World, it includes over 50 countries. So even if the US stumbles, your portfolio still has global exposure. It also includes non-correlated sectors like healthcare, energy, and manufacturing from around the globe. It even includes emerging markets, which historically have higher long-term growth potential. Obviously, that comes with more volatility, of course, but the idea is simple. You reduce your dependence on only one economy, political decision, or central bank, and that's how real diversification works, not by owning 500 companies that all operate in the same country with similar risk profiles. So if the risks are this obvious now, why is the S&P 500 still so widely recommended? And the answer is simple. Simplicity sells. It's easy to understand. It's easy to track. And for American investors, it feels patriotic. Plus, many of the vocal influencers and financial educators are US-based, so naturally they promote US-centric solutions. But here's the problem, because what is simple isn't always what's best, especially when the future is so uncertain. Just because the S&P 500 worked in the past, it doesn't mean it's the optimal choice going forward, especially not when there's a more globally diversified option with very similar fees and better long-term balance. So in my opinion, if you are serious about long-term investing, it might be time to look beyond the S&P 500. The FTSE All World gives you exposure to thousands of companies, dozens of countries, and a much broader foundation for growth. But even with the right index fund, if you are going to deal in individual stocks, you do need to know how to evaluate these before buying them. And that's where you do need to get serious and do the hard work. And if you want to learn how I personally research stocks, the ones I actually trade, then check this video next, because you'll see exactly what I look for and the red flags to check to help you avoid losing money. Thanks for watching, and I'll see you in the next one.